Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. Just now to go now until the closing bell, and stocks are ripping higher here. The Dow up over 900 points as war tensions ease. And Jared Blickery has the latest. Jared.
Yeah, this is not your grandfather's sleepy Friday market here. Check this out. You said the Dow is up 1.8%. Let's check out the intraday price action. Before the market opened, we got this nice bump off of some Strait of Hormuz headlines, and you can see it's up 1.81%. Been in the green all day, just gapped up, and it's been hanging out near the top. Very similar situation for the Nasdaq, up a little bit less. S&P 500, even less, but still over 1%. And the Russell 2000 small caps had been lagging this week. It was more about some of the Mag 7 and some of the bigger ones. But today, the small caps are outperforming. And I mentioned the Mag 7, so let's just show you what they're doing. Up 1.5%. Dow Transport's nearly 3%, and that is another record high. And then you take a look at what's happening with the chip stocks. I think this is day number 8 that they have been hitting record number highs. And they're also up 13 straight days, as is the S&P 500, as is the Nasdaq. Lots of stats to keep track of in my head, but semis up another 2% today. I'll just show you. For the 5 days, they are up 7%. And software, up even more, 13.6%. So software is a come from behind story this week. I'm going to delve into that in a little bit, but let's check out the VIX first. You can see the VIX down to 17 at the lows of the week. That is definitely moving in the right direction. And we can also see that Treasury yields, 10-year T-note yield, down 6 basis points to 4.25%. The big move came this morning before the stock market opened. That was still off of that Straits of Hormuz opening headline. U.S. dollar index has been down 9 of the last 10 days. It is down again today. That has really shaped this risk rally and supported it. Meanwhile, Bitcoin, it is up 8% this week to 77,300, and that is a 2.5-month high. I know you're going to be talking to somebody about that in a little bit, Josh. First, let me get to our large cap sector action. This is what happened today. Consumer discretionary in the lead, up 2.5%. Then you have industrials up 2%. Then healthcare, tech, staples, all of those up more than 1%. To the downside, we got energy and utilities. Energy down nearly 3%. That's as crude oil kind of crashed down to by about 10%. Let's show you what happened today in the Nasdaq 100. And here we see a lot of green in the Mag 7. Tesla up 3%. That's another come from behind story this week. Apple up 2.5%. Alphabet as well. And here's let me just show you the 5-day price action where you can see Tesla up 15%. And that is the leader of the Mag 7 group. So nice outperformance there by Tesla. I do want to delve into software. I'm going to show you what happened this week. And you can see if I sort by performance, you've got a lot of outsized winner. Oracle with some new contracts are up 25%. Ring Central and Unity up about 20%. Snowflake and Datadog and Shopify just behind them. It really goes down the list here. Now, I do want to show you what's happening on the 13-day, because this rally began 13 days ago. We've still got a lot of software stocks in the red off of that. And I'm going to show you one scary chart, one scary heat map before I go. This is how far each of these software names are off their 52-week highs. So everything by red is going to be red just about by definition. EA is just slightly off. That's a merger and acquisition story. Cisco is pretty close to its highs. But check out the bottom row here. We got Atlassian down 70%. HubSpot 67, Zscaler 60%, Thomson Reuters 57. So a lot of these are still broken stocks. It's nice to see the rally here. It's nice to see software leading, but it's going to be a big test for the market overall if they can continue this into the coming weeks. So I'm going to end things there and send it back to you, Josh.
All right, thank you, Jared. Well, investors will also be eagerly watching Kevin Warsh's Fed nomination hearing. That's set for this coming Tuesday. Jennifer Schonberger joins me now to unpack what to expect. Jen.
Hey there, Josh. Front and center is going to be central bank independence and how Kevin Warsh responds to how the president might pressure him to lower interest rates and how he would safeguard the independence of the Federal Reserve. I expect questions from both sides of the aisle on this issue. Ranking member of the Senate Banking Committee, Senator Elizabeth Warren, already out, very critical of Warsh, saying after she met with him yesterday that she believes he will be Donald Trump's sock puppet. Now, Warsh also expected to get questions about monetary policy. And last year, before he was officially nominated to be the head of the Federal Reserve in January, he was actually quite critical of the Federal Reserve, saying that officials needed to throw away the notion of stagflation, that tariffs constitute a one-time increase in pricing, and that AI will boost productivity so much that it will push down inflation, allowing the Fed to cut rates. The question now is, does Warsh still hold that view? What are his current views on monetary policy? And has the geopolitical events in the Middle East and the subsequent oil price shock impacted his outlook, at least in the near term? And how will that coalesce with the rest of the FOMC, which is more prone to looking to holding rates steady at this point? Also on the table, of course, is that there is no path forward for Warsh's confirmation, even though we have a hearing on Tuesday. And that is, of course, because a member of the Senate Banking Committee, Republican Senator Tom Tillis, has vowed to block Warsh's confirmation until the Department of Justice's investigation into current chair Jerome Powell is resolved. So it remains to be seen how this nomination could even move forward after Tuesday's hearing. Josh?
And Jen, before we let you go, we heard some remarks from Fed Governor Waller on the economy as well. What did he have to say?
Yeah, so Waller actually striking a bit of a cautious tone himself, basically saying he's not looking at the notion of cutting rates in the near term, whether the conflict in the Middle East proves short-lived or not. If it does end up proving short-lived, he wants to sort of watch how things steady out before returning to the notion of perhaps rate cuts later this year. If it ends up being a more protracted scenario, then Waller is looking at the notion of not just higher inflation, but lower employment. And so he says at that point, he would really need to assess what the bigger risk is there. And if the bigger risk is inflation, then he would be content to hold rates steady.
All right, Jen, thank you. Coming up, we check in on how home sellers are feeling about this housing market. That's next on Market Domination. Well, it is no secret that the housing market is facing an uneven recovery, with buyers having regained some footing, but sellers are keeping their optimism. And Realtor.com chief economist Danielle Hale joins now to discuss. Danielle, always good to see you. So one number that jumps out here, Danielle, this is an interesting stat. You say 83% of sellers think they will get their asking price or more. Now that is optimistic. What do you make of that? You think is that accurate, Danielle, or no? You think people are perhaps setting themselves up for some disappointment? What do you think?
I think in order to decide to put your home on the market, you've got to think that you're going to price it right. And that's what that data really shows us. Those shares are actually very similar to what we saw at this time last year. So roughly half of sellers expect to get their asking price, and a little more than a third expect to get above their asking price. A much smaller share are actually expecting to get below their asking price. So sellers are going in with some high expectations. This survey that we did of sellers that gave us those numbers also showed that sellers are expecting a little bit more reasonable terms when it comes to the contract itself. So even though they have high expectations on getting their asking price, they do show that they are more likely to expect to have to make a concession to buyers this year compared to last year. So even though their asking price expectations are high, they're not completely untethered from the fact that it is a softer market for sellers and buyers have some negotiating leverage.
When you say concessions, Danielle, what does that mean? Is that like price cuts? Is that repairs?
Yeah, it could be covering repairs. It could be adjusting the timeline of closing, maybe, adjusting the date of closing. Anything that is a bit of a sweetener in order to get the deal across the finish line and to make that home sale happen.
It's never kind of one size fits all for this housing market, Danielle. Where do sellers feel the most in control? Are there actual sort of like important regional differences?
Yeah, so we did break this data down by region and asked sellers whether they expected they were in a buyer's market or a seller's market or a balanced market. Nationwide, the vast majority say that the market is either balanced or favors buyers, but 40% nationwide said that we are in a seller's market. But that varied, with sellers in the Northeast and Midwest more likely to say that we're in a seller's market, and sellers in the West and South more likely to say that we're in a balanced or buyer's market. And that does match our data on regional variation in negotiating leverage across the U.S. We recently released a market clock, which identifies buyer-seller leverage across the U.S. And in producing that market clock ranking, we found that it is the most divergent housing market in the last several years. So conditions really vary locally, and our survey data shows that sellers are aware of that variation.
You all say here, Danielle, right now, mid-April, this is the best time to sell. How come? What makes this window so special?
So this time of year is really unique for sellers. It's an opportunity because most sellers are not yet in the housing market. We do see a seasonal ramp up in the number of homes on the market. More sellers get into the game, but it's usually not until May that we get to the peak new listing time period for sellers. In the meanwhile, a lot of buyers start their home search earlier. If they've got a rent lease that's up maybe in the spring, they want to get in the market. They need to get accustomed to what is out there for options. And so they're already searching. As a result, we look at the number of buyers per listing, it is really at peak levels at this time of year. So that makes it a really good time for sellers to get into the market. They can expect higher than average prices, a relatively quick sale, and have a less likelihood of having to make price cuts in order to get their home sold if they list in this best week. But it's not to say that if you've missed it, you can't list your home for sale. Of course, the spring in general is a more active time for the housing market. So even if you've missed this week, which is the best week, I wouldn't say that you're too late. The sooner you can list, the more advantageous the seasonal conditions will be for you.
What generally, Danielle, is motivating sellers right now to sell? Do we have line of sight there? I mean, is that, let's just cash in on these higher prices, life changes? What do you see in the data?
It is a mix. So some sellers say that profit motive is something that's driving them to sell right now. And even though our data show that asking prices have come down, we know that they're not very far off of peak prices nationwide. And in some markets, they are still at peak pricing levels. So profit can be an important motive. But remember that a lot of sellers are not selling and then turning around and renting. They're selling and then buying. So very often an important motivator is making sure that the home is the right fit for them. They're moving for family reasons or job changes. mortgages or other moves that they need to make in order to make sure that they are where they need to be from a housing perspective.
Let's say your home doesn't sell, Danielle. Any sort of common sense, practical advice you give, tips and tricks, guidance on next steps?
Yeah, I mean, if you're not getting offers, then that's the market telling you that you've got something wrong in the price or the offering of your home. So a good rule of thumb is to take a look at your pricing and make an adjustment. In the last year, we saw that when sellers weren't having their expectations met and they weren't getting the price that they wanted, many of them were, instead of cutting their price, choosing to delist their home. That suggested that they weren't the most motivated sellers and that they wanted to rather wait out the market than adjust lower in the price. But if you've got a home that you really want to sell and you're not getting offers, adjusting your price is a really good move. That's the market telling you that you maybe need to set a different expectation given market realities. And I think, it's worth talking about the broader condition. I mentioned softening asking prices nationwide. We've had some ups and downs in mortgage rates. Fortunately, that roller coaster is on the downswing now, which is a little bit better news for both buyers and sellers. But it is something to be aware of. The macro context is rather uncertain. And so sellers would do well to keep that in mind when they're setting price and expectations as they approach the housing market in 2026.
Yeah, Danielle, I want to end here actually on the 30-year fix. Per Mortgage News Daily, I'm just looking here, we're at 629. Where do you see that headed, Danielle, over that's, call it 6-12 months from here?
I expect a little bit more stability this year than we've seen in the past couple of years on mortgage rates. And so I think we'll see them in the low 6% range. That's about where we were before the Iran conflict. We actually got just below 6%. So we could see mortgage rates settle just below 6% if we get a really complete resolution to that conflict. But I think it's going to continue to be a wild card that'll keep rates just above the 6% mark through the rest of this year.
All right, Danielle, as always, great to have you on the show. Thank you.
Thanks for having me.
The life expectancy for the average American is getting longer. The CDC expects most of us to live to at least 79 years old. As more people live longer, they need the financial tools to prepare them for that healthy life in retirement. Yahoo Finance executive editor Brian Sozzi spoke to the CEO of life insurance firm John Hancock about the company's personalized longevity preparedness tools.
We do have some important insights, I think. If you look at the past 100+ years, one of the great achievements of humankind is a radical extension of life expectancy. 120, 40, 50 years ago, life expectancies were 45. Now they're 79 and growing fast. We all have these wearables and screenings and all these things. And I think there's a very underappreciated story in our society and in our economies around longevity. There's still this notion of 65 as a retirement age. Well, that was set, in the 1880s when life expectancy was 45. Most of us with any kind of luck are going to spend decades past 65. So really important questions about what that looks like for the economy, for us as individuals, living healthy those longer years. And that's what we're really leaning into as a company.
Brooks, to be clear, I am excited to have you here. And life insurance is exciting to me. I'm not maybe as excited about it as you are, because it's your business, but I am excited to have you here. What is the economic effect, you think, of people living longer?
So first of all, as an industry, you could see why the life insurance industry would lean in on this. I can let you in on a little secret, Brian. In addition to friends, family, maybe a pet who wants you to live a long, healthy life, no one wants Americans to live longer and healthier than the life insurance industry, for economic reasons for sure, but also as a matter of values and principles. So a couple simple facts. One, most deaths today in the US, significant majority, are associated with lifestyle diseases. And thus, they are heavily influenceable by choices we make every day. Do we exercise? The quality of our diets? How much do we drink? Do we smoke? All those types of things you're familiar with. So much more influenceable than ever. And you combine that with all the technology, there's a real impact for us to extend those lives. So we're all going to live longer and hopefully are more healthy. It presents all kinds of other challenges. Am I going to have enough money for retirement, things like that, or those extra years? And some other challenges like who's going to care for me if I need care. You get to a certain age and you're either going to be one who needs care or you're going to need to be a caregiver for someone you care about. Is my home going to be ready for those types of things? But there are real opportunities too. What do I do with that extra time? I can't even imagine just sort of riding off into the sunset at 65 personally, and just kind of hanging out for decades.
Neither could
One
I.
can only fish so much.
I can't imagine it.
So, right. So how do we turn that into productivity? And even as an economy, Brian, we're going to have to figure out how to harness the energy, the brain power, the productivity of people in their 60s, 70s, 80s, even 90s. Every day we see in our business a record number of people turning 100. And that number is expected to quadruple in the next 30 years. So how do we harness that productivity, address the challenges, financial and other, but meet the opportunities as well?
Is the reality, Brooks, that people are just going to run out of money in their retirement? For people that have planned diligently for years, they think they're set up for success. But if they're living to 80 to 90 or even 100, like you're pointing out, I can't imagine they've planned accordingly.
Well, first of all, we just came out with something called the Longevity Preparedness Index, which you can see on our website, that did a survey of Americans of how prepared are you to live these extra years, these extra decades, really. And everyone always asks that question about financial. And to be honest with you, that is a challenge for Americans and my industry, financial services industry broadly. And of course, public policy has to be set to encourage more savings earlier. And I understand the reality and challenges of people, struggling right now to fill the gas tank. A little easier, hopefully, after today. But there are real challenges there. But it's not just about financial. So yes, we need to lean in on that. But one of the big drivers of how financially secure you will be in those older years is how healthy are you? Number one concern of retirees, will I be in good health in retirement? Number two is, will I be able to afford my health care in retirement? So we're trying to lean in and help Americans not just live longer, but live more healthy longer while saving, because if you're more healthy in those later years, guess what? There's going to be less financial pressure.
Brooks, we are still living, despite the pullback in oil prices today and hopefully gas prices soon, we're still living in an inflationary backdrop for so many things. How much have you had to increase prices for plans this year because of everything going on in the world?
Yeah, Brian, it's funny. We're in somewhat of an enviable position. Our company turns 164 years old next week. And we tend to have very long duration liabilities that we match with long duration assets. So we're not as subject to relatively near term. I guess I would say we take a very long-term view of things. So while I'm extremely sensitive to the impact of higher gas prices, which affect so many consumers right away, for our business and the pricing of our business, the profit profile and so forth, they tend not to be overly influenced by what we would call near-term factors. We tend to look at irreversible things and reversible things. And I would say what we're seeing today, hopefully, is the beginning of something that was reversible. There was this near-term period of conflict and disruption, and hopefully today represents the beginning of the unwinding of that and a return to normal, which is sort of what we price for and offer to our customers over a very long period of time.
Lastly, Brooks, before we let you go, the mortality rate for the industry, I mean, we've seen this go up really since post-pandemic, and it's been a headwind to the life insurance industry. Are we beyond the worst of that? And by mortality rate, I just mean more people are dying.
Yeah, well, I mean, certainly COVID represented a blip. I mentioned at the beginning of my remarks this incredibly powerful, almost nonstop upward trend in life expectancies in the U.S. There was a blip in 1917 for the Spanish flu. There was a blip in 2020 and the couple years after associated with COVID. It's my belief, based on what I'm seeing, that is normalizing. And frankly, I'm bullish on longevity and mortality long term. You just look at the science and technology that's out there. Many of these companies we partner with to bring their services to our clients, full body MRIs, multi-cancer early detection tests, all sorts of new cardiac screenings and things like that. We will all be so much more empowered around our personal health that I think you'd be very wrong to bet on continued extensions in life expectancy in the future.
All right, we'll leave it there. Happy birthday next week to you and the team. Brooks, good to see you. We'll talk to you soon.
Thanks, Brian.
Coming up, Tesla's on track to snap its losing streak. We check in on that stock coming up next. Believe it? Tesla is seemingly turning things around this week as the stock is on course to break its losing streak here. And Yahoo Finance's Varun Subramanian joining us here to discuss it all. All right, Pras, so you write about how Tesla trying to stop an 8-week losing streak. It's poised, you say, to finish the week actually higher. Now, why is that? Is that, you say, short-term technical bounce? You say, no, this is real momentum. What's going on?
That's the question, right? Because so on Wednesday there was a big bounce in the stock. After 8 weeks of losses, Al Root at Barron's was the one that I saw. He mentioned that first, the stock was mired in a pretty rough slump here in the spring. Had a big pop on Wednesday, and that coincided with some news about Musk talking about how they taped out the latest AI5 chip, or they finished the design process.
Stop right there to bring us up to speed. What is that chip, and why are investors excited?
It's their latest sort of AI chip. They call it, that would power, let's say, FSD driving in cars, Optimus robots, a number of different things. That it was an in-house made chip that they're making, and they want to eventually make in the Terafab, right? Among other things, that's that big project they're doing in Texas to make chips. So there was some news, Musk talking about that chip. Some people use that as a launching pad for the stock, right? I think Gene Munster said that he thought that the 80% of the move was because of this news. It seemed to me a little flimsy. Talking about the design of the chip is complete. They haven't started making anything yet. So I guess there was sort of, like you said, maybe a technical reason. There was the sentiment had been so bad in the stock. You have some broader market, obviously today, good stuff today, good stuff this week, and then that sort of launched the stock and Nasdaq tech stocks too. But so I guess that's what's happening. But then you also have earnings coming up, and that's the next phase or the next catalyst, maybe.
What are you listening there for earnings, by the way? I'm curious. What's on your radar?
It's always been sort of like, what are we going to hear about FSD? What are we going to hear about robotaxis? And Morgan Stanley talking about how they might hit 10 billion miles of FSD driving. That's a nice milestone to have. And you use that data for training the software and optimizing the whole system. But yeah, we want to hear about FSD. We want to hear about robotaxi rollout. What's going on with the beyond Austin, beyond Bay Area? Are we going to see those new territories, new regions activated? Are we going to see the safe driver removed? That sort of thing. Also, we've seen the Cybercab actually being built in Texas right now, showing pictures of it online on the parking lots. When is that going to come out? So production has begun. Is it just pilot production? Is it actually true production? Are we going to get these on the road? Apparently no steering wheel, no pedals. So it's happening.
Let's stick with Tesla, because there was another headline I want your take on. Bloomberg had this one. With this piece, you saw this. Nearly 1 in 5 Cybertrucks, they say, sold last quarter went to Elon's own companies. They say if you strip out those sort of internal purchases, Pras, Cybertruck sales would have actually dropped more than 50%. What is going on there?
That's a surprising amount. I mean, I guess you're comparing it maybe to a low base last year, and I think it was over 1,300 vehicles sold, something like that, to SpaceX. And I'm not surprised that we're seeing SpaceX buy these vehicles from Musk's company, right? They need these vehicles at Starbase and places like that. Why not buy the vehicles from Musk's own other car maker? Well, if you're a SpaceX investor, you say, hey, there should be an arm's length transaction here. Why don't you put this bid out? Maybe we buy 1,000 Ford F-150s. I don't know, So I think there's a little bit of why are they buying the Cybertrucks? Secondly, you were asking about this before. What does it say about Cybertruck demand? Is it really not great? And I think that the EV demand in general is sort of kind of tailed off a bit. And you're talking about a pickup truck that costs $60,000. It's an EV. Secondly, how many people who buy work trucks want to have an EV? That's the debatable question. So I think that it's a combination of, look, the thing looks polarizing, but it's pretty capable. And we're talking about EVs for larger trucks. They're not the best fit for that sort of powertrain. So there's a lot going on there, but it is notable that SpaceX bought a bunch of these.
And I guess there was probably some Tesla investors and shareholders listening to us right now probably rolling their eyes, because for them, I mean, Cybertruck isn't why they're in this name.
Right. Yeah, but and then I just saw Tesla tweeting today about how Cybertruck is now the premier vehicle for them, because the Model S and Model X are going away. This is the top dog now, is Cybertruck. So got to beef up those sales.
Finally, you got a new report out, a story about Charlie Ergen. Walk us through that one.
Yeah, so basically, we're walking up to the SpaceX IPO, and one of the things that caught my eye, and you know Charlie Ergen, this guy is just a bigger, larger than life kind of character in the old days of satellite cable TV, right? Well, it turned out, in my story I talk about this, a few years ago, he's hoarding a lot of broadband, because he knew that spectrum was a valuable thing, and he wanted to supposedly develop a 5G network. He never did that. It was debatable whether he was just camping out on the spectrum. Well, it turned out a couple years, well, actually last year, FCC Brandon Carr saying, hey, what are you doing with this spectrum? You need to actually, per the rules, you have to actually use it. You can't just sit on it. And it turned out that they were able to make a deal where SpaceX sort of wanted that because they want to do their D2C or direct-to-cell service where you actually use a unmodified phone to get cell phone service via the satellites, via ground operations, et cetera. So they needed to get some spectrum. Charlie Ergen had it, sold a bunch of it, and last fall, he basically sold, he got $11.1 billion valued at $212 a share for SpaceX, right? But that was when SpaceX was a $400 billion or so thereabouts valued company, right? That's quadrupled by now, right? So doing some math here, they have about 3% stake, if not accounting for dilution. That $11 billion stake could be worth around 32, 40 billion or thereabouts just by holding it, right? So it's a nice little stake there for Charlie. He's known as guy was a pro gambler before he even started, selling satellites literally off the back of his truck. So interesting story there. He could be one of the guys that benefits. You
say EchoStar basically, you put it like this, Praz, in your piece. It's basically to becoming a SpaceX tracking stock.
Yeah, I mean, if you say that their SpaceX stake is worth 32 billion or thereabouts, currently right now in Yahoo Finance, EchoStar is worth 39 billion. Right? So what does that tell you? It kind of is tracking that stock. And Ergen probably disagree with you, but that's what's happening right now. And then people are bidding up. The last 6 months, the shares have been bid up tremendously because it's been tied to SpaceX.
Great story. Praz, thank you, sir. Appreciate it. Well, SpaceX is expected to mark a significant shift in the space economy as the market awaits its public debut now. The highly anticipated IPO is particularly drawing in a heavy focus on the retail investor. And joining us now to talk about all this, with a closer look at Justice Parmar, Fortuna Investments CEO, who is also, by the way, a SpaceX investor. Justice, good to see you again. So let's start here, Justice. Bloomberg is saying, you saw this, SpaceX raising its target IPO valuation to more than $2 trillion. That's with a T. So for context, that would be worth, more than Meta, for example. Does that number make sense to you, Justice?
Well, look, I mean, a couple things. I think once we started this process in terms of going public, the company's been growing at an amazing clip, and so the company's been doubling year over year for the last handful of years. I think the $2 trillion number, well, as rich as it sounds, and it obviously turns a lot of heads, it's really a super company. It's got several different businesses all combined into one. The crown jewel from the cash flow department is a company called Starlink, which is in the SpaceX business. And so there's a lot to kind of double click though. And so I do think the 1.75 trillion or even $2 trillion valuation, which is it's an aggressive valuation. I think if you turn around in 3 or 5 years, it's going to look to be a very cheap valuation.
What, Justice, would you say is this company's sort of just strong, competitive, defensible moat, Justice?
Well, I don't think it's one particular defensible moat. And so when you look at the greatest companies in the world, they've all got that moat that you're describing. You mentioned Facebook. Facebook's got a moat. Google's got a moat. NVIDIA's got a moat. Amazon has a moat. All these companies have moats. And so if you break down the SpaceX business, they have a reusable rocket called the Falcon 9, which goes up once every day or two. On cadence. It's the only company in the world that can do anything like that. So that's definitely a defensible moat within the launch business. Now, Elon's going to transition that into something called the Starship. But similarly, I mean, they can take payload up in cadence. They're like 90% of America's launch market. So that's definitely a moat. And keep in mind, it's not just the launch business anymore. They have the Starlink business. Starlink definitely has a moat around it. Amazon just bought a business this week to kind of compete with that business. But SpaceX and Starlink are so far ahead, there's a moat around the Starlink business. And then if you want to get into it, we can. It's up to you. We can walk through the Grok and the XAI side of the business as well, which I'll argue has a very strong moat on those businesses as well. You combine that all together, you really have a super company. And this is obviously a retail investor and institutional investor show. It's going to be the first time ever in the history of the world that you're really going to be able to buy Elon. All the companies are going to be in this one company, and some would argue maybe Tesla ends up in this. And the only thing that we've ever been privy to kind of see like something like this is basically Berkshire Hathaway in a different way. Berkshire was a bet on Warren Buffett. This company will be a bet on all of Elon Musk's beautiful endeavors that he's got underway.
You know, it's Elon's world, Justice, and I take your point there. I'm also interested, get your take on the team he's assembled. You know, the folks who are actually running SpaceX day to day. You know, I'm curious, as an investor, what you make of that team. You know, Gwynne Shotwell, for example.
Yeah, she's fantastic. I've met her a handful of times. A very, very brilliant woman. She's grown this company exceptionally well. She's technically smart. Obviously has a great support system, you know, around her. I think one of the benefits of working in the Elon umbrella is he's got a lot of the most brilliant people in the entire planet in terms of engineering, bench strength, people who solve, you know, great problems. And so she can draw on all these amazing resources. And then the thing is, you know, it's not like they've been sitting on their hands. They're really pushing their envelope in terms of what they're looking to achieve. And they're obviously really making some noise. And the very exciting thing is from the retail perspective, in terms of the offering, they really want to try and get retail involved. So there might be an opportunity for retail to actually participate in the IPO. They're trying to carve out maybe 10 or even up to 20% of the entire offering for retail. What that might look like could be something like Morgan Stanley is one of the underwriters. E-Trade is owned by Morgan Stanley, so there may be an allocation to E-Trade. We'll see in the next 30, 45 days, maybe a Robinhood, a couple of these things. But Elon is the people's champ, and he really wants to try and get retail investors into normally what would only be an institutional and sovereign IPO.
To your point, let's put a number on that, Justice, because reportedly SpaceX is expected to allocate 30% of shares for retail. That would be a whole lot more than usual. And I'm just curious what you make of that. Why is Musk doing that?
Well, I think a couple things, right? I think, I think he is the, man of the people. I think he definitely he cares for his customers, right? He sells products. Elon sells products. He sells Teslas. He sells a lot of different products. And so you want to take care of the people that support you and that buy from you. And so I think that he's acutely aware of that, where some companies might not be so aware. And so he's really pushing forward to carve out an allocation. Now, look, I don't know if it's going to be as high as 30%. I mean, crunch the math on that. 30% of 75 billion is $25 billion. That would be the largest IPO in the history of the world was Saudi Aramco, and Saudi Aramco raised $28 billion. And to give 25 billion to retail, I don't know if there's that much demand for retail, but I think it'll be a healthy amount. And so to answer your question, I think it's to appease the people. I think he wants the people in early or before the stock maybe really takes off, kind of thing. And he really loves his customers.
Justice, so you're a SpaceX investor, meaning you thought through the potential rewards here, but you also thought through potential risks. What are the risks, Justice? Would it be regulation or cost? Would it be competition? How do you think about it?
So that's a great question. Technically, I don't really, to be honest with you, I don't think there's anything that Elon and his team can't solve. He's been doing impossible things his whole life. So technically and operationally and executionally, I wouldn't, although it's a huge risk, he's doing something that's never been done before. If I was a betting man, I would bet on him and that team. So I think technically they'll be able to figure it out. It wasn't that long ago. If you look at the previous administration, and administration and government policy actually makes a difference. And he was having a hard time with the previous administration. He was trying to get the rockets up and down as quick as he could. The rockets would sit on the pads waiting for a relaunch. He'd wait for a stamp from Washington because of some turtle or some EPA type of issue. And he really felt that the last administration was slowing him down. And so I guess what I'm trying to say is he's been able to run over the last kind of couple of years under this new administration. If there is an administration change, in a couple of years, I think that's something that might kind of slow his progress. Capital, he's able to get the capital. Technical expertise, he has the technical expertise. So I think he's in really, really good shape. And in terms of competition, he doesn't really have the competition. Even if you look at Jeff Bezos, who's one of the wealthiest people in the world that's created one of the best companies that the world's ever seen, and being Amazon. Blue Origin is quite far behind Elon, right? So the competition isn't there yet, but we are shaping up to look at a space race. And lastly, my last point is there's a company that kind of sort of looks like SpaceX. I'm not comparing this company to SpaceX, but it's publicly traded, called Rocket Labs. They're in the launch business. They've launched 70, 80 times now. They're in integrated systems. They're vertically integrated. Peter Beck, who I know, is doing tremendous things over there. I think it's a $40 billion market cap or so. Very well run company. But and again, I'm not comparing it to SpaceX, but it's kind of a mini SpaceX.
I am curious, Justice, just final question. Let's say, SpaceX, you have the IPO, Justice, let's say it's a success. What would that mean just for kind of the broader, space-focused economy, startup ecosystem?
Yeah, that's a terrific question. And so sometimes, our problem is we get so fixated on the weeds, the day-to-day. We're so invested in the day's news. And sometimes we stop to basically take a huge step back and see the trees from the forest. And so what I'll say is I think this is going to be a transformational moment, not only for the capital markets, given that it's going to be the largest IPO in the human history, but I think for the space industry, it's a once in a lifetime. I think when we talk in 10, 15, 20 years ago, we're going to remember this period for the rest of our lives, because it's, in my opinion, it's going to be not dissimilar to kind of the dot-com, late 90s, early 2000s internet boom. What was once thought impossible and unfathomable is about to happen here, and Elon Musk and SpaceX are about to kick it off. So it's going to be an extremely exciting couple of years in the industry, and it's going to bring a lot of players that you've never even heard about to the forefront. And so it's going to be very exciting for the investing public.
Justice, great to have you on the show. Thank you for your time. Enjoy the weekend.
Always a pleasure.
Coming up, crypto and risk on assets are rallying here on hopes on a long-term ceasefire. We'll get into that price action of Bitcoin. It's coming up next. Let's take a look at some poly-market odds now for what price Bitcoin will hit by the end of April. Traders predicting prices will hit 80,000 as the most likely outcome right now. Let's now unpack the wider crypto space. Scott Melker joins me, host of Yahoo Finance's brand new show called The Daily Wolf. Scott, good to see you. So let's talk Bitcoin and price action, Scott, because you're still down about 40% from that all-time high, but we had been in this range, 60 to 75. You've broken out of that now. You're sitting here at a 2-month high. What do you make of the recent price action, Scott, and where do you think we head from here, near intermediate term?
I definitely think we're going into the 80s, and I think it's effectively a rounding error when you've already pushed towards 79, of course. As you said, we've been in that range between 60 and the mid-70s here for quite a while, and there were a lot of reasons underlying this move beyond the news headlines and the Straits of Hormuz, as usual. I mean, we had effectively 270,000 Bitcoin bought by whale wallets, the largest wallets in the last 30 days. We have exchange supply of Bitcoin at effectively an all-time low, the lowest it's been since 2013. And we have funding rates on perpetual exchanges negative, which rarely happens. It means there's a lot of shorts that were there at resistance to be squeezed. So I think that this was more of a technical and fundamental move by Bitcoin and not particularly driven by the headlines. That said, obviously, it's nice when macro is in your favor and is buoying the price. But I think that Bitcoin has been effectively a beach ball held underwater for quite a while here. And there's a long way to go before we would even be talking about a bull market where we could get a huge bear market bounce at the very least.
What did you make of some of the headlines this week, Scott? Charles Schwab announcing plans to launch spot crypto trading. Goldman files for that Bitcoin ETF. What did you make of that news flow?
We've had crazy news flow. Every institution has had a major announcement in the last weeks. I mean, leave out even last week when Morgan Stanley launched their own Bitcoin spot ETF, entering a crowded space where there's already 10 Bitcoin spot ETFs, which tells you two things. A, they don't want to give up those fees to BlackRock, right? So they're creating their own ETF, even though they're a commercial bank, the first to do so. They're on the sell side. This is not a company that generally launches ETFs. They're doing it because they have an army of 17,000 advisors and salespeople out there that can go capture the audience and start selling these Bitcoin and Ethereum products, in their case, Bitcoin. The Goldman one is even a bigger piece of news because Goldman has been hush-hush on Bitcoin and crypto in general. They have not really made a massive move into the space, and they're offering this income ETF, which will allow them to sell calls against spot holdings of the ETF. So that's a new product that we haven't seen, and BlackRock also has announced a similar product. And then Charles Schwab, obviously, offering Bitcoin and Ethereum spot services. It just shows you where the puck is moving. Their customers are obviously demanding it. They know that they're about to have their lunch eaten by the Coinbases, OKX, Krakens, Geminis, and Robinhoods of the world if they don't get in line.
What about strategy? Acquiring $2.6 billion in Bitcoin in the past 2 weeks per Bloomberg. How much is, in your opinion, that helped sort of just underpin the market, Scott?
I think it definitely helps, right? I mean, having a fixed demand floor that is going to come in predictably every couple of weeks probably gives a lot of confidence. I mean, as you said, Monday and Tuesday with STRC were absolutely insane. I think, they were able to buy 24,000 Bitcoin in 2 days after buying 14,000 the week before only on STRC. I hate terms like infinite money glitch and flywheel, but it seems that right now, Michael Saylor, at least at the time with Bitcoin prices rising or staying where they are, really has found a way to continue to very easily raise massive capital and shore up the balance sheet by buying more Bitcoin. So I think that as Saylor goes, so does the market, right? I mean, we have this situation right now where their cost basis is $75,557 per Bitcoin. He looks like an idiot, unfortunately, to the market, which I disagree with when he's underwater. Now their Bitcoin holdings are back in profit, and everybody thinks that he is a genius again. It's incredible, though. I mean, he's just vacuuming up way more Bitcoin than's being mined in a deflationary asset with fixed supply.
Scott, we think of Bitcoin as volatile, of course. Is it as volatile as it used to be, Scott?
Not nearly as volatile as it used to be, and it's not even as volatile as some of the biggest companies in the world, right? When you have overnight moves on Meta that go 30% or NVIDIA all over the place, and what we've seen with oil, silver, gold, Bitcoin is starting to look like the stable store of value versus these other assets that used to be viewed as, stores of value and stable. I mean, we had silver moved a full bear market in 5 or 6 days, right? I mean, everyone was talking about Bitcoin being down 50%. Silver was down 40% in a few days. what took Bitcoin, a couple months to do. So this is not the same asset that it used to be. It's obviously maturing, but that said, when you look at the Bitcoin market historically, it makes most of its moves to the upside in about 10 days a year. The rest of the time, it's usually sideways. So that volatility will come back. And if it comes back to the upside, you're going to want to own this thing.
Scott, always appreciate your time and congrats on that new show.
Thank you, man. Can't wait.
And for more Polymarket odds, scan the QR code on your screen to go to Yahoo Finance's Prediction Markets Hub. It's powered by Polymarket. And don't go anywhere because Scott is launching Yahoo Finance's brand new show about all things crypto. The Daily Wolf cuts through the noise to deliver the day's crucial crypto news and developments, and that does premiere Monday on Yahoo Finance. Well, coming up, we got you covered through the closing bell on Wall Street. That's next. stocks ending the day in rally mode here, and our very own Jared Blickery has the very latest. Jared.
Thank you, Josh. What a week to be in charge of market stats. Let's begin with the Dow here, up 1.8% for the day. That's 869 points. Here's the intraday price action. Guess what? Over the last 5 days, we are up 3.2%. That is the best week since last June. Nasdaq, the best week since last May. Ditto for the S&P 500. Meanwhile, the Nasdaq Composite and the Nasdaq 100 and the Philly Chip Index and XLK, that's large cap tech, are up 13 straight days. We have not seen that in years in these indexes. And here's the S&P 500 up 4.5% for the week. And let's do small caps too. They are up 2% today, leading the way higher for today. And for the week, they are up 5.5%. And it's not just the small ones, it's also the largest ones. Magnificent Seven leading the way, up 8.6% this week. And meanwhile, tech was up 14%. That's IGV. And for the first time in a long time, software is doing better than chip stocks. We're going to have to see if that lasts into next week, but so far, so good. Now, let's take a look at the sector action, and there we go. That looks a lot better. Here's consumer discretionary in the lead. That's up 2.4%, followed by industrials and real estate and tech. Healthcare, staples, all of those, everything on the top row up more than 1%. What didn't work today? Another down day for energy and utilities. Crude oil, by the way, was down about 10%. Here's the Nasdaq 100, a lot of green here. So spoiling the party just a little bit is Netflix, which I'm circling there. That was down almost 10%. But you take a look at Tesla, that's a come from behind story, up 3% today. Broadcom up 2%. For the week, look at these gains in the mega caps. Tesla up 15%, Meta up 9%, so is Broadcom, Amazon up 5%, Microsoft up 14%, another come from behind story, so the list goes on. Dialing it back down to intraday, let's take a look at the Dow. You're not going to see a lot of red here. Chevron, that's the energy trade, which didn't do too well. That was down 2%. J&J and Verizon, arguably defensive trades, those were in the red. But you got Sherman-Williams, Merck, and Home Depot each up 3%. And I will close here by showing you software, what happened this week. And let's do this on a 5-day basis. Lots of huge gains there. Oracle was one of the biggest winners, up about 27%. And then we'll take a look at chip stocks. Not too shabby either. A couple red spots, but NVIDIA up 7%, Broadcom up 9%. And our perennial leaders here this year, SanDisk and Western Digital, each up 8% this week, Josh.
All right, thank you, Jared. Let's take a deeper look at the market as Wall Street wraps up the trading week. Jay Hatfield joins me on set. He is Infrastructure Capital Advisors CEO and Portfolio Manager. Jay, always great to see you. So let's just start right there on the stock market, surging today. What do you make of that, Jay? Do you say, you know what, that response makes sense? Do you say, we're getting it kind of over our skis here? What did you think?
Well, we should have been on a month ago because we were predicting a mid-April power rally.
Why? Why did you say that?
Because it's really just a normal seasonality. So after, a simple way to think about it is earnings season is for greed and after earnings season is for fear. And we had all the fear you could possibly imagine. So we had AI fears, 2 of them, credit fears, and then the war. So it was really a disaster, but the market didn't even go down that much. So we thought 2 things would happen. First, just have earnings, so we get the real data versus all the fears, because we thought they're all massively overblown. And then number 2, we did think, we didn't know exactly how, to be fair, that there would be some sense of a resolution on the war, that it's not going to last forever. So we got both of those things. We got the power rally. So we never pulled our 8,000 target, and we never pulled our 375 target on the 10-year.
Let me ask the question different. Let's say, so WTI, Jay, all right, we're back down to 84. Let's say we hung out around 84. We didn't go back down to pre-conflict 65 and change.
Right.
Is that a problem for the economy or corporate profits?
We didn't even think it was that big of a problem if it stayed over 100.
You didn't?
Not for the US.
Yeah.
Rest of the world, yes. But we have free natural gas, basically. It's 250, it's 10 times, up to 10 times that much during the war. So that both our electricity prices and natural gas are capped because it's a waste product of drilling for oil. So when oil prices go up, actually natural gas goes down. And we benefit from that low cost natural gas, so we have more industrial competitiveness. So we're only forecasting a 2.5% growth in GDP versus 3.3, so a little bit lower. And rates, hang out around 4.25 and a 7,500 target. So that wasn't our scenario, but just because we thought the war would get resolved. It's not resolved yet. But it's not Armageddon for the US. I wouldn't want to be in Europe, wouldn't want to be in Asia if the strait remained closed.
What do you say to those strategists, Jay, who've sat in that very chair, and they've told me earnings expectations are too high. They got to be ratcheted down because that oil price shock is going to hit bottom line.
Well, for a couple of sectors that we don't really trade in, they're 100% consumer facing. There'll be a little bit of impact, but keep in mind that gasoline price is only 3% of consumer spending, and they've actually been low recently. And most of corporate profits are driven by tech companies. They're not affected by energy prices. And also, most strategists, for some reason, kind of miss the dynamic that earnings growth really comes from the retention of earnings and investment, not necessarily a booming economy. So if you have a slightly slower economy, it's not actually likely to affect earnings much. And by the way, if we had an absolutely booming economy, it's like a minor tailwind, but it's really mostly, think of McDonald's. It's building the new McDonald's, not the existing McDonald's. So whether prices are higher, lower, consumers under pressure or not, that McDonald's is going to be roughly returning whatever returns. But they're going to take the free cash flow, build a new one. That's what produces earnings growth. So normally, strategists are way too conservative about earnings growth.
Let's talk about the Fed as well, because that Warsh Senate hearing, that's April 21st.
Right.
How important is that for the market, for Warsh to get the nod?
Well, I don't think Warsh in particular, he's actually pretty hawkish, although I think he'll be fine in the short run. But to have a Republican as the chairman is critical.
Why do you say that, Jay?
Well, most Republicans are more monetarist oriented, and they recognize the money supply is not growing. You should always look at the money supply. The current Fed does not. That's why they missed the big run-up inflation and had that bogus transitory theory. So you want more monetarists in place, and you want monetarists are in general better at forecasting inflation. And so the Fed has been terrible at that.
Well, you think they're, correct me if I'm wrong, we've talked about this before. Don't you think they have basically a flawed inflation measure, correct?
Correct.
Yeah.
Yeah, that's the other problem. So they use PCE, which uses what's called imputed prices. So that's a fancy word for they made up the prices.
What should they be watching?
They should look at real-time market prices. So not owner's equivalent rent, look at rent. Rent is flat. Don't delay it 6 months on purpose. Like, it's a scandal. Why do they wait 6 months? It's sort of like if you did your show 6 months delayed and reported on the close 6 months ago. How long would you be in business? Well, the problem with government agencies is that they can't get fired, but they don't update owners, or actually all of shelter, except every 6 months. So that's pure insanity. So I'm hopeful that Warsh will both forecast inflation better and use the proper indices corrected for real-time prices. And you can get that. We publish it on our website. There's something called Truflation. It's about 1%. So you can get real-time market prices. You don't have to rely on these arcane methodologies that BLS and the BEA uses.
All the strategists, I've got to tell you, recently who've been on this show, are telling me their base case now is the Fed doesn't move in 2026. They're all coming on saying, I think they're sitting on their hands. Is that your base case?
Absolutely not. We're normally non-consensus, but I don't think this is humble, but normally correct, is that we've given up on being humble. But we have stuck to the 3 cuts because we thought the war would end. So we always just have a base case scenario, because having all these confusing scenarios doesn't really help. So we believe that oil will come down to, say, 70. 80 is a little bearish. We think 70. And then in the back half, not now, but in the back half, you'll have rapidly decreasing inflation, not just because the energy shock is over, but also tariffs are going to be passed through. So energy might stay a little elevated, but every month it's going to be 0.1, 0.1, 0.1, 0.2. And I think the new Fed will annualize and say, oh, we are headed to 2, which we already are at in our numbers, but poorly reported by the BLS. And so we'll get 2 to 3 cuts. We'll get the 10-year below 4. REITs will work. Financials will work. And so we stuck to that. We had to answer the question because we're not all knowing. I didn't know how the war exactly was going to end. I just thought it had to. like I said, the scenario is not that bad. So maybe 7,500 on the S&P, 4.25. So it's actually totally fine. So there's no reason to bail out of all of your stocks in March just because it wasn't entirely clear how the war was going to be resolved.
Jay, always great to see you, especially on set. Thank you, sir.
Thanks, Josh. Thanks for having me on.
Well, most Americans don't feel they have enough saved in retirement, so what's the solution? Our very own Carrie Hannon joins us now with some answers. Carrie, great to see you. So you say here, Carrie, in this piece, if you're struggling for retirement, something is better than nothing. Walk us through that, Carrie.
Well, yeah, here's what happens, Josh, is, this is a lot of the reporting I did on this from a study that came out from Transamerica Institute. And they, year after year, they ask people, how much do you think you need to save for retirement, for a comfortable retirement? And people inevitably say, I need, 7 figures. I need, $1 million plus. But then you say, well, okay, so how did you come up with that? And they're like, well, I guess. And so that is like no way to come up with how much money you need to have for retirement. And so, what's the problem here, Josh, is the majority of Americans do not do a budget. And fewer than that put together a financial plan. And even fewer than that have a written financial plan. And, you ask people, well, what's going on? How come you're not focusing on this? And what they're saying is, I just have too many other things to worry about. I'm worried about healthcare costs, and I'm worried about housing costs. I'm already working a second job. I am dipping into my credit cards and my retirement accounts. All these factors right now have people kind of, let's just say it, Josh, they're blue. I mean, people are just down in the dumps and they're not taking action because, in this study, they showed that only 15% of those surveyed were actually optimistic about the future. So here's what I say. What you have to do is just simply one little step will get you started. Run a retirement calculator. Just do this one thing. Yes, it would be great to get that financial plan put together. Super if you'll do the budget. But if you can do a retirement calculator, and AARP has a good one, Vanguard, Fidelity, Schwab, right online, super easy. Put in your numbers, and study after study, Josh, tells us that people who just do this one little thing actually end up with getting closer to their targeted amount of savings than those who don't. It's simply the act of starting to focus on it and pay attention. It really, ignites some sort of motion to make this happen and become a reality.
You did say a lot of people think they need 7 figures to retire comfortably. And I've heard that myself, Carrie. But you say that often that's actually just kind of a guess, right?
Yeah, exactly. They're throwing a dart. So, I mean, if you don't take the time to, if you can sit down with a financial advisor, absolutely the best thing you can do. But if you just have a little bit of time, you're not ready to go that far along, at least run that retirement calculator. At least, try to get a beat on what it is that you're going to need.
You have another story I want to get to, Carrie. New retirees' top regret. And what is that? Well, you say more than half of recent retirees say their biggest regret is not saving enough. Walk us through that one.
Oh, yeah. What a surprise, right? It's like that's what they're telling. I mean, this is another report I looked at this week, and it's just going like, oh, my goodness. These are people who retired. They looked at people who retired in the last 5 years, right? Now, Josh, let's think about it. It's been kind of a crazy bunch of years here. There's been high inflation. We've had a pretty volatile stock market. So people are understandably nervous, but they looked at retirees who have stepped out in the last 5 years, and they're going like, I don't have enough. If I had talked to my younger self, I would have said, save more, or don't expect you're going to be able to work as long as you actually want to. And these are very real feelings. This is not to take lightly. And I think that what happens is, and what this study shows is people who are getting nervous like this, especially these new retirees, they're actually starting to pay attention to their investment portfolios, which is fine on one hand, but they're making changes. And we all know that often might not be your best move to go shifting things around just when things are a bit rocky. And the important things everyone needs to remember when you're nearing retirement, you've absolutely got to have paid attention to your cash reserves, what your asset allocation is in your portfolio and what your withdrawal strategy is, how much you think you can take out each year. This can change, but at least have an idea of what you're doing, because these first few years are super critical to your financial success down the road, that having this stretch out and last as long as possible. And I talked to a woman who she retired 4 years ago. And, you know, the first year she retired, Josh, the market, the S&P was down 19%. So she said it was like super scary, but she was able to just sit tight because she had 2 years of cash reserves set aside and she knew she'd be okay. And in fact, yeah, she was.
Carrie, always great to see you and have you on the show. Enjoy the weekend.
Thanks, you too.
Coming up, experts break down the hype around Claude's Mythos model. That's next on Market Domination Overtime. AI world is abuzz over Anthropic's new Claude Mythos model, the startup calling it too dangerous to be released to the masses. Now, Anthropic has deployed Project Glasswing, enabling just a select few organizations to experiment with Mythos. JP Morgan CEO Jamie Dimon saying after using the model that it, quote, shows a lot of vulnerabilities that need to be fixed. Anthropic's CEO is expected to meet with the White House Chief of Staff today to smooth over tensions between the startup and the administration as Washington looks to get its hands on the elusive AI code. So what sets Mythos apart? Well, join me now on that. We got Zach Pass, Rutherford's AI Advisory Council futurist and former OpenAI go-to-market executive, and Sherry Davidoff, the founder of LMG Security. Welcome to you both, Zach. I'll begin with you, and maybe, Zach, it would be helpful. We just start with kind of the basics here, Zach. Can you just break down what is Mythos, just in simple layman's terms, Zach, and why is everyone suddenly talking about it?
Layman's terms, it's a much more capable model that has both coordination and intelligence upgrades in agentic properties that actually allow it to sort of not just go forward and backwards as it executes tasks, but could step side to side. And in doing so, is just much more capable of executing tasks and goals on an individual's behalf across applications, data lakes, and browsers.
You say here, Zach, though, we've seen this movie before. That's how you put it. So I guess let's cut through the hype there. I mean, is this really a historic breakthrough, Zach, or are you suggesting, no, there's some element of sort of branding and marketing going on by Anthropic?
Well, both can be true. So I think we should be really clear. As these models get more capable, we are enabling a lot more to happen, both good and bad. And this presents the promise and peril of technology and artificial intelligence in this case. And we should acknowledge that as excited as we are to see us cure cancer, we should also be equally anxious about what low resource bad actors can do. And when I say we've seen this movie before, what I mean is humans have a proud history of being very anxious about technology that we build, especially on the eve of its adoption. And you don't have to go back that far to find headlines about GPT-2, OpenAI's model that was built in 2019, and the concerns that we had about it and what it would enable low resource bad actors to do. Obviously now, given the fact that we are operating on a pretty antiquated internet with a lot of antiquated cybersecurity policies, Mythos presents new surface area to be exploited. And that in and of itself is reason for the companies to be concerned. But it doesn't mean that it's new in that, we are upgrading our humans' ability to just do more things.
Sherry, bring you in here. I'm curious, who do you think should be sort of paying the most attention to this, most worried about this, Sherry? Is it everyday consumers? Is it Sherry and Josh? Is it the small business owner? Is it the large multinational? Is it all three, Sherry?
Yeah, make no mistake, this is going to affect everybody. But I would say certainly anybody involved in a small business or a mid-sized business should really be paying attention. We have a case right now of the haves versus the have-nots. There's about 40 tech companies that have access to Project Glasswing. And the reason this is important is because Anthropic's new model is able to find vulnerabilities in software and exploit them at a pace faster than anything we have ever seen. So that means anybody that gets their hands on this essentially has like the closest thing we have to a hacking right, can break into things. And vendors, people that make software, don't have time to patch those vulnerabilities. They are working probably around the clock right now trying to patch these thousands and thousands of vulnerabilities that have already been discovered, and they will only find more. So again, there's some tech companies that already have their hands on this, and we're going to start to see the impacts trickle down in the form of new software releases, updates, more patches, things like that. So we all really need to be paying attention and applying those updates.
Yeah, I was going to ask you, Sharon, if I was a business owner, I was listening to you, I'd be getting kind of nervous at this point. Are there steps I should be taking?
Yeah, first of all, think about what you have that's facing the internet. If it doesn't need to be on the internet, don't put it there. There's a lot of times we can take software, put it behind a firewall. It doesn't really need to be a website out there. So that's first and foremost, step number one. And then step number two is talk to those who provide you with software, whether it's a third-party IT company or your software providers. Find out how they're going to be dealing with these vulnerabilities and the patches that will be coming out, and make sure that you are on the priority list, that you're going to be getting these updates right away, and pay attention to those.
Zach, back to you. Anthropic CEO reportedly, Zach, you saw this, meeting with the White House today about Mythos. I'm curious what you make of that, Zach.
I would love if our government has the latest and greatest technology, whatever it is. And I'd certainly hope that we have much better coordination than we've had in the past between Silicon Valley and the White House. And I think that the current administration has shown glimpses of being far more cooperative with Silicon Valley. In some cases, obviously, the recent dust up between the two is suboptimal, I think, really for everyone. So I'm frankly just glad to hear that they're going to patch things up.
Should we assume, Sherry, that foreign adversaries, Russia, China, have similar capabilities, have a mythos of their own?
I love that you asked that question. And yes, Anthropic, they're a company that chose to announce this to the world. But who's to say that China doesn't already have this, that the US government doesn't already have something like this? So this is the one that we know about that has been announced in a press release. These capabilities may well already exist in other hands. And frankly, any researcher or any tech company that does have access to Project Glasswing, we have to assume that they're targets and that other actors are going to try to get access to this as well.
Does this, Zach, I mean, when you think about Mythos, does it sort of just fundamentally shift or alter the balance of power between sort of the good guys and the bad guys?
Well, yes and no. There's a bigger question underneath all of this, which is on the arc of human history, does technology favor good actors or bad? And if you play every story out long enough, good actors win out, which is why the world tends to get better over time. What it supports is low resource bad acting or first mover advantage. And this has been discussed ad nauseum at this point, but one of the reasons in good faith that Anthropic wouldn't open source this model or release it even in a closed environment is that we really want most of our infrastructure to prepare for what happens when a jerk in a garage has access to it. And the safe assumption, even if we don't think a government has this capability today, is that they'll have it in 9 months. So we now are on a sprint to basically update as much infrastructure as we can, such that in 9 months, when this technology is open source, which is basically the average lag between frontier and open capability, everyone's prepared for it. And this is basically now the new normal. I mean, the new normal needs to be understood that technology is moving at a rate that we should assume low resource bad actors and medium resource bad actors will have a strange first mover advantage that we need to, one, policy against, and two, put exceptional effort into cybersecurity work to make far more robust the infrastructure that we have let languish for way too long.
Zach, Sherry, great discussion. Thank you both, guys. Appreciate it.
Thanks so much.
Coming up, we look at the validity of some of the most viral personal finance hacks making waves on social media. Don't go anywhere. Hello and welcome to Asking for a Trend. Well, financial stress for U.S. adults is hovering around peak levels now. The National Foundation for Credit Counseling expecting the first quarter of this year to show stress rise to a new historic high. For more on how Americans are handling their finances, let's welcome in now entrepreneur and Maconomics creator Ross Mack. Ross, it is great to see you. Let's start here, Ross. You say that people now, they're earning more, but they're keeping less. Why is that, Ross? Walk us through the reasons.
Well, one, thanks for having me. And two, I think what you really have to say is the pace of revenue, the pace of earnings, the pace of wages keeping up with the rate of inflation? And the simple answer is no, right? I think that we as consumers in America are obviously much more stressed with rising inflation, the rising costs of goods. And as a result, you have people seeing much more stress. As a result, we're having record credit card debt, right? When it comes to people thinking that they can attain the American dream, right? The idea of when you can afford a home is getting further and further out of grasp.
What are they most stressed about, Ross?
Well, it's a multitude of things, right? And when we talk about people having record debt, people pulling from their 401ks just to make ends meet, they're stressed about a multitude of things. And that is one, just the day-to-day living expenses, right? Gas prices, groceries being higher, the fact that people not being ready for retirement, the retirement becoming further and further out of grasp. So I think it's a multitude of things.
And yet, Ross, I take your point, but we just heard from the big banks, right? And these big bank CEOs on the conference calls, they were asked point blank by these analysts, hey, how's the American consumer? And the CEOs basically said, Ross, listen, not much has changed. I mean, they look at the American consumer, they said, healthy, resilient. And then I saw this Bank of America stat. In March, total card spending, ex-gasoline, healthy growth, they said, at 3.6% year over year. So I take your point that sentiment is rough, but people are still spending, Ross, and I'm curious what you make of that.
Well, one, I think is very important when we think about, kind of a top-down approach of how the overall economy is. You got to understand, right? This is K-shaped, right? There are people, they're going to be the tale of two worlds, right? The have and the have-nots. And so the haves are obviously seeing, once again, record stock market, record growth in asset prices, right? However, there's a world where a lot of people don't actually own assets. And as a result, when you hear that inflation and just overall the cost of living is increasing, what are they doing to make those ends meet? And as a result, they're turning to their savings, which one was depleted during COVID. And as a result, now they've yet to really fully refurnish their savings. And now what are they doing? Some people are pulling from their 401k. Some people are heavily reliant on their credit cards purely just to make ends meet and meet day-to-day expenses.
Let's, Ross, talk about some personal finance trends. Interested to get your take. Got micro payments, no buy months. You got friction maxing. Are these actually helping people, Ross, in your opinion, or is it really just about people kind of making themselves feel like they're doing something, they're being productive?
Well, one, I think it's a little bit of both, right? It is helping people feel as though they're being productive. At the end of the day, people want to have some type of control, some type of discipline. And if it's a trend that they need to actually do that, then so be it, right? I think long term, it doesn't necessarily fix the problem. What it does is effectively put a Band-Aid on the problem. And obviously there's a deeper root cause. However, if you're able to do one of these, whether it's micro payments, saying I'm going to pay just a little bit, much more frequently every Wednesday, the idea is, okay, we have some control. Now we are finally getting some momentum with this. However, if we still have multiple credit cards, we have to use micro payments, however, with a larger plan to actually get out of debt, whether that be debt snowball or debt avalanche, right? I think when it comes to the no buy, that's interesting, right? Okay, everybody, no buy April, no buy November, right? That's awesome. But what happens the following month? Are you going to find yourself saying, well, now I'm actually just going to, have some reward spending because I made it a month. And now I would have spent, $1,000 in May, but now since I didn't, maybe I spend $900 the following month. And so, it's a great idea. It's just a function of, do you couple that with a bigger solution overall?
So if these are sort of short-term fixes, Ross, what are more sort of just structural, real, long-term things people should be doing to build real personal financial strength and resilience? What are some basic rules of thumb in your opinion?
I love it. One, I think people don't understand. Everything starts with financial therapy, which is helping you truly understand and change your overall relationship with money. It is a true reason why the average American is bad with money, and it's, subconsciously inherited bad relationships that could have, they could have learned it through osmosis. However they viewed their surroundings, their upbringing, their parents, how they dealt with money. Unfortunately, just like, genes, the height is in the family. Well, guess what? If your parents were potentially bad with money, you could also inherit that. So I think getting to the root cause of why a person might be overspending to look like they have money, or if you grew up on Spam and eating ramen noodles, maybe you might be inclined to want to overspend and Uber Eats food quite often. And so understanding what the root cause of why a person is bad with money and then trying to overcome that. And then it's very simple, which is the next step is budgeting, right? I think people need to truly control their inflows and outflows, obviously minimize, impulse spending, and also ensure that when it comes to the cycle of going into credit card debt, is it because you're overspending? Is it because you didn't have a fully funded emergency fund? And so I think those are a few things. And I think another thing people could do is utilize is AI, right? I think everybody who has multiple credit cards should literally save down a PDF of the most recent 3 credit card statements, their bank statements, and as a result, upload them to whether it be ChatGPT or Claude, and literally tell AI, hey, you are my financial advisor. I need you to help me figure out where I can cut spending, bucket this into my necessities, my wants, and as a result, let's come up with a plan to help me get out of debt in 6 months or 12 months. And I think that's, a few interesting ways.
Ross, thank you for your time today. Appreciate it.
Oh, man, thanks for having me.
And the new show, Real Money with Ross Mack, is out right now. You can catch it every Friday on YouTube, Spotify, and Yahoo Finance's 24/7 stream. Well, stick around. Much more Ash for a Trend still to come.
Thank you.
Iran says the Strait of Hormuz is now completely open to commercial traffic and a major step in easing tensions with the U.S. Veda Partners' Henrietta Treyz joined Julie Hyman on Market Catalyst this morning to discuss this and a whole lot more.
I would say, once again, you got to read the fine print. The Iranians have said that the part of the strait that is open is specifically the portion that they have already approved as a route for maritime traffic to go through. I immediately looked up how much has gone through there. On average, it's 14 ships a day. At most, since the war started, it's 20 ships a day. Now, I don't know about you, but that doesn't sound at all like 130 ships that we were used to before the traffic started, before the war started. So when you hear the insurers say we need to be sure about safety, the only thing that matters is the mines. And the mines have been deployed across, I would, 2/3 of the strait. And that portion of the strait is not navigable. So whether or not the blockade is there, whether or not it's open to commercial traffic, that's all fine and well. I think what that means is the U.S. and Iran have come up with an agreement on how to get traffic through and possibly some sort of deal about the Ayatollah. And the two are the $1 million a barrel tax that the Iranians were imposing on any of the tankers that went through. Maybe they came up with some sort of agreement on that piece because, of course, in order for commercial ships to go through and pay that toll, they would immediately violate OFAC rules and U.S. sanctions, which come with a double tax on the U.S. side and a risk of 20 years to life in prison should you pay a sanction to a verified supporter of terrorists, which is how we designate the Iranians. So many, many questions. I'm not at all convinced this will get us back to the flow of 130 ships that we were expecting. It should not be taken that way by the street. That's not what the Iranian minister said.
Henrietta, you've been talking to a lot of investors recently. I was reading your latest note on this. The market wants to be done, right? The facts on the ground aren't necessarily supporting that it's done right now, or that that oil prices are going to really come down substantially in the immediate future. So what are you hearing from folks about the sort of disconnect, which is not terribly unusual in markets, but it is interesting given the situation and the facts on the ground?
Yeah, the market's optimistic impulse just can't be beat. It's my favorite. Everybody wants to be happy and ride the AI boom. They see the U.S. exceptionalism trade coming back into play because, of course, Southeast Asia, China, the EU is so much more exposed to a closed strait than we are. So the U.S. exceptionalism trade is definitely getting a fresh breath of air from the investment community. The real thing I point out is that if you feel like you're walking in an upside down space where we are deploying not one, not two, but 3 aircraft carriers to the region. We are getting reservists, we are getting Navy men and women, Marines out into the arena at levels not seen since 9/11. I call around and talk to folks in Florida just recently this week to check and see what the deployments are. They're getting rapid deployment letters to 3,000 people at different bases across northern Florida, which is where so many of them are around Mayport and the areas. So all those continuing data sets are still with us. We have this huge military buildup, and yet the market continues to hit fresh highs. So the disconnect between what the market is seeing and then certainly what American voters are feeling, the pessimism, the lowest consumer index since World War II, you got a lot of competing forces here. And my favorite comment is really this idea from one of my clients who said, we're getting a lot of verbal intervention. And I would say that the president's commentary this morning definitely qualifies as some of that.
Yes. I'm also, turning to the voter piece of it and the implications for the midterms and then by extension for, say, economic policy in the markets. The other headline I have to say that caught my attention this morning was a report from Axios that amidst these trade talks, amidst these peace talks between the U.S. and Iran, or ceasefire talks, one potential element is the U.S. could release $20 billion in frozen Iranian funds, according to that report, if Iran gave up its stockpile of enriched uranium. I don't know if those will be unfrozen via pallets of cash being delivered to Iran, but I just wonder how that is going to play amidst all of this other, back and forth.
Love a pallet of cash. I mean, if $20 billion is what it's going to cost to remunerate the Iranians for the war, I think that's really interesting. And where does the uranium go? Does it go to China? Does it go to Russia? I mean, the reality is that this war has been a massive windfall for Russia and for Iran. And this is another example of that. So Axios has had some incredible reporting. They are obviously getting word from the White House directly, pretty far in advance in a lot of instances throughout this war. So I don't doubt that this is an idea that's been upheld or broached. $20 billion is a sum that is, not for nothing, but it's nothing to the United States budget. We spend $1.6 trillion a year just to keep the lights on. So $20 billion over to Iran to get in exchange for uranium would be really interesting. I wonder, though, whether Iran would accept that, because they, are getting potentially much more than that from this Iran toll, the Ayatollah, as we're calling it. And I think it's really interesting that the president tweeted today calling it the Strait of Iran. So, there's a lot of questions there about whether that number is going to work.
Yes, there are. I want to turn to another big event that is coming up in D.C. that there are a lot of questions about, and that is over Kevin Warsh's confirmation hearings scheduled for next week, April 21st. Of course, Senator Thom Tillis remains a holdout because there is still the investigation into Jay Powell that is hanging over the proceedings. How do you think this is going to play out here? Who do you think is going to blink first, the Department of Justice or the senator?
Well, I'm privileged enough to have just spent some time with the senator personally, and I can tell you that man is living his absolute best life. So the potential for him to walk down and somehow get off the idea that this investigation is a bad idea seems extraordinarily unlikely. The senator knows exactly how many days he has left in office. It's 270 or some odd, and he is very happy to stand up for financial freedom and the independence of the Federal Reserve. And I think it is a real internal belief that he has that this is really critically important. And I would say that I went up with a couple of our clients, our closest clients. One of the things we offer is to bring you and meet with members and staff. I love to meet with staff as a former staffer. And I can tell you that the financial community is so grateful that the senator is standing up for the independence of the Fed. It's such an integral part of our government, of our financial system. It's what separates us from the rest of the world. And I think that the street is very supportive of this idea of an independent and audit-free Fed the way that it is right now. So for the president to perpetuate this, browbeating of Powell is completely counterproductive. He's not going to get his nominee seated, whether there's a hearing or not. Tillis is not backing down.
So do you think the DOJ will be forced to back down?
They're going to have to. The alternative is wait until Tillis is gone. And just for the record, he doesn't leave until January 3rd, 2027.
And so, okay, so if the stalemate continues, then what could happen? I mean, presumably Powell sticks around, but how does it play out? Who ends up then being the chairman, and how are decisions made, et cetera?
Yeah, the decision-making function is completely, untested at this point. So there's going to be a lot of internal conversation at the Fed. But my expectation is that Powell stays on. Powell and Tillis speak with some frequency, and I think that there is support from the entire Republican conference in the United States Senate, with a few exceptions, to have Tillis continue to lead this fight. He's carrying a lot of water for a lot of other members. So, I met with the senator before Powell came out with his press conference and said that he was planning to stay on, and the suggestion was that Powell could stay for the entire duration of his term, and certainly for some period of time after the May 15th expiration of his term, and then also for some period of time to ensure that even if the DOJ dropped the investigation tomorrow, there would be a continued presence to I don't know if it's the right way to say it, but sort of like provide a backstop for the other members of the board to make sure that there is somebody who's willing to stand up to the president, as Powell certainly has done, to make sure that there is sort of a cool hand on the tiller, providing a shield for the rest should there be a reinsertion of fiscal dominance. So I think that Powell will stay on for at least a couple of months, if not the remainder of his.
Stick around. Much more Ashford Trends still to come. Time now for what to watch on the market, gearing up for a big week for earnings and the economy. On Tuesday, Kevin Warsh faces his confirmation to become the next chair of the Federal Reserve, but his path to confirmation is uncertain as Republican Senator Thom Tillis refuses to move the nomination forward unless the Justice Department's criminal investigation into Fed Chair Jay Powell is dropped. On the earnings front, we're going to hear from the first of the Magnificent Seven, Tesla. The EV giant reports at the closing bell on Wednesday. Wall Street expects the company to report earnings of 35 cents per share on revenue of just over $22 billion. Demand questions loom large after weak first quarter deliveries, but with the recent surge in gasoline prices, Tesla may be seeing more buyer interest. Beyond Tesla, we're going to get earnings from a slew of companies that are facing fallout from the war with Iran. United and American Airlines will be reporting, and the guidance will be key as executives weigh in on the impact of soaring jet fuel prices, and the report United floated the idea of a merger to the White House. And defense contractors Northrop Grumman, RTX, and Lockheed Martin are on deck. Investors will get a sense of what the backlogs look like as lawmakers consider a new $1.5 trillion defense budget.